Good afternoon. Welcome and thank you for joining us today for a webinar and conversation with our CEO, Don Shaffer, entitled Walking Off Wall Street. And I'm Alex Haber. I'm the program manager in our Philanthropic Services department. I'm excited to be with you all today to help facilitate a conversation with Don, during which we will explore the dominant culture of Wall Street finance and our vision for the future. We host these conversations with Don a couple of times per year, and we'd love to get your input. We'll be sending a feedback survey tomorrow morning and would appreciate your thoughts on today's webinar and any suggestions you may have for future topics. Today, Don's going to take the first half of our time together to present, and then we'll use the remaining time for our questions and answers. We know it's hard to have a true conversation given the webinar format, but we're hoping to create as much of a discussion as we can. We'd like to run a quick poll to see who's on the call. So if you take a look at your screen, you should be seeing a poll, and you can select any that apply to you. We've got 69 people right now joining us on the call today, which is really wonderful. Just give people a minute on the poll. Great, so it looks like we have a good diversity of participants today, a number of finance professionals and people interested, just simply interested in our work, and then a smaller handful of RSF investors or donors and RSF borrowers or grantees. So thanks everyone for that poll. So just a few logistical matters before we get started. To ask questions, please type them into the chat box, which you see on the screen here. You should also see it on your screen. You should see a control panel. If not, you can see the small red arrow. You click on that and the control panel should expand. The best way to view the presentation is in full screen mode. If you click on view, you'll see that it's probably defaulted to window. You can select full screen there. Also, please note that if you're having trouble with your computer's audio, you can phone in using the information provided in your registration email. Okay, great. I think we're ready to get started. I'll turn it over to Don.
Thank you, Alex. Let me say first off that just to be crystal clear, that we are not financial advisors or investment advisors here at RSF. We don't receive any funds or money from our clients to provide investment advice. And when we talk about investment opportunities with partners in the investing arena, they shouldn't be taken as recommendations or advice. So, obligated to tell you that. It's really good to be talking with you. I look forward to as much of a dialogue as we can have today, and hopefully this will be the first of a series of conversations that we do on and around this subject. And I know that with many of you, I have this as an ongoing topic. So before I discuss this quote that you see in front of you, I'd like to say that I'm not trying to position myself as an expert on all things Wall Street. For those that know me, you know that this webinar is a natural extension of pretty much my entire life. I've been inquiring into how the financial system works, who it serves, etc. And so, and my perspective comes from pretty direct experience. I grew up in New Jersey, in a town where there were many Wall Street bankers and traders that lived there. Many of my friends growing up through elementary school and high school, and then in college, where I went in upstate New York, went on to work or have gone on to work in Wall Street. Some of those friends of mine, were retired by the age of 40 as a result of the work that they're doing on Wall Street. And so I have firsthand experience, and a lot of where I'm coming from comes from kind of pain and disorientation from growing up in that kind of culture, and the need for understanding. I've just basically been on a pursuit to try and understand as best I can how the system works and what we can do about it to hopefully make it better. So this quote, I wanted to start, before getting into Wall Street itself, I wanted to start with this quote, which pretty much summarizes our entire point of view here at RSF in a nutshell. So in case you don't have a screen in front of you, it says, when each financial transaction is direct, transparent, and personal, it will be possible for an economy based on love and mutual respect to emerge. And so this is essentially a challenge statement to all of us. It's my interpretation of why RSF exists. Our purpose statement is to transform the way the world works with money, but this statement kind of goes deeper into what we mean by that. And you'll notice that there is a direct linkage between finance and the economy in this statement. It's conditional on purpose. In that, from my point of view, I feel like it will not be possible for us to build an economy based on love and mutual respect until we have financial transactions that are more direct, transparent, and personal. And it turns out if you go deeply into this, what I've found and what we've found is if you use this as a screen or as a filter, as we do, it yields a really interesting set of decisions about how to respond to the culture of money that we have today. So it'd be great to at least say a word or two about what is Wall Street, or what do we mean by Wall Street. And some of this may be a bit repetitive to the blog post that I put out last week called Walking Off Wall Street. But so bear with me if you read that. But the way I think of Wall Street, simply put, is it's a way of describing a money culture based on transactions, not relationships. And further, it's dependent on a kind of growth that we don't feel is prudent or necessary for us to have a highly functioning society and really healthy human relationships, as well as relationships with the natural world. And with that said, and I guess I want to make a statement about using the term Wall Street. In no way am I saying that people who work for big banks are bad people, or people who work for big multinational publicly traded companies are bad people. That should not be construed at all in what I'm saying. What I'm mainly going to be talking about today is the distinction, let's just call it, between trading and investing, and how that relates to what's emerging in the impact investing world. So we'll be talking about two things. The idea that a lot of Wall Street is geared towards trading, not investing, and then we'll talk a little bit about what's happening in the impact investing world as it is mainstreaming. But in my view, particularly since 2007, 2008, I believe we're experiencing a failure of imagination and a failure of will to change a system that clearly seems to be broken and maxed out. And the big banks are bigger than ever. They're more powerful than ever. For those that don't know, between 1990 and 2010, the financial services industry spent more money on lobbying in Washington than I think it was transportation, telecom, pharmaceuticals, and the agriculture industry combined. So these are just things that we have to know. So what have we done here at RSF that's concrete to respond and put into action what our core values are? I'll just go through these briefly as examples, and happy to talk with any of you more, offline or after this about other things that we're doing. These are just some prominent things that we've decided to do. So in September 2009, we decided not to use the London interbank offering rate as our benchmark for setting interest rates on the direct loans that we make. That's what LIBOR stands for. This is essentially a Wall Street benchmark that's used to set interest rates for literally trillions of dollars of loans on a daily basis. And we were reading at the time, we were doing a study group on Rudolf Steiner's lectures in 1922, from 1922 on the topic of economics. And we said to ourselves, why are we using LIBOR? Why don't we use our own community-based methodology? And many of you know that that's what we've done ever since fall of 2009, is we pulled together our investors and borrowers each quarter, along with representatives of the RSF staff, and we decide together what interest rate the borrowers will pay the next quarter and what rate of return the investors will get. So that's LIBOR. In December 2010, we sold all of our public stocks. Because we felt that even though the underlying companies are not necessarily bad companies or definitely not bad people, it's just they're participating in a financial system that we didn't feel like we could believe in. And this was just some months after the flash crash on May 6, 2010, which, if you're not familiar with that, I'm not going to go into it in detail, but I urge you to check out the headlines from that time, from May 6, 2010, what's known as the flash crash. And then while you're at it, if you want to watch a documentary called The Wall Street Code, I highly recommend that, because it outlines in some detail how the high-frequency trading and algorithmic trading systems work on Wall Street today, and how they're representative of about 80% of all the trades that happen on the international stock markets today. So I highly recommend the Wall Street Code, and there are others like that, and of course other books like Michael Lewis's The Big Short and many others that have chronicled this. But we just felt we could no longer believe in the Wall Street brand of finance that was where things had gotten to by the 2010. So we sold all our public stocks. And truth be told, if we had held them, the Dow Jones average, I think, was about 12,000 at that time. Now it's about 17,000. So we would have a bigger balance sheet today if we had held on to those stocks, but we would not be in as close adherence to our core values. And so we feel good about having done that. As we speak, we're ending our relationship with Citibank that we've had for quite some time. Here again, we just don't feel like we can do business any longer with the too big to fail banks. And if you read the Wall Street Journal, you read other Financial Times or other newspapers, New York Times, you'll see that there are still many stories in the news about the fallout from the LIBOR scandal. As it turned out, several years after we decided to abandon LIBOR, it was found that that rate was being systematically rigged by the 16 big banks that control it for their short-term gain. And now, as we speak, finally, there are some criminal trials that are emerging from that. And so Citibank and others were involved in not only that scandal, but many, many others that have resulted in billions of dollars in fines, and essentially them owning up to the fact that their culture is broken, and that that's now sort of a cost of doing business if you're a big bank, is to have to fork over these gigantic fines to compensate for bad behavior. So part of one of my things is that this is not an issue of there being a few bad actors at this point. We're talking about a culture that is just not is not, these organizations are not showing up in the world in the way that they need to. And again, it's just a failure of imagination if we think we can't do anything else. So next slide, Alex. So if we want to talk about the mainstreaming of impact investing, let's talk about that subject for a moment. First of all, let me say that I'm a big fan that more and more people are aligning their money with their core values, and they're seeing, whether it's what they buy at the store or where they bank or how they invest. They are searching for meaning in how they express themselves with their money, and in many ways, it's kind of a spiritual journey to ask yourself deeper questions about how am I showing up in the world with my money, and to go deeply into things like, what is my personal relationship to money, and do I need to look into that and how what effects it's having in my life. But I feel like there are many theories of change that are needed. RSF's perspective and my own perspective are certainly not the only ones, and there are many smart, conscientious, creative, phenomenal human beings working on the mainstreaming of impact investing right now. However, the question is, what assumptions are not being examined about how the impact investing conversation is happening today? And again, I'm not the only one to be looking into this, but I will name some questions, such as, are we replicating the same structures and forms and belief systems as exist in Wall Street, just applied to trying to do more good with our money? We need to ask ourselves questions like, what rates of economic growth are we tethered to in order to make all of our capital markets to continue functioning the way they do? How much liquidity do all of us as investors really need? Because that's what Wall Street hangs its hat on, is that we have the most liquid capital markets in the world here in the United States, and that's a fundamentally good thing that should never be questioned. And I would ask the question, how much liquidity do people really need if they're doing real investing instead of trading? Should we be so obsessed with measurement of impact? That is a hot topic right now. I don't have time to go into all these at the moment. I'm just flagging some we could maybe go into later. Things like, are post-World War II rates of return a God-given right for all of us? Or is this an anomaly in history where there have been huge productivity gains that have created financial returns, whatever you want to call it, in the 7 to 11% annualized return range for public equities? Is that something that just by definition is going to continue to happen, and should we all be counting on that for retirement savings? What are we as investors really able to know about the giant companies that we're invested in? I think the Volkswagen scandal, the past couple of weeks is sort of exhibit A of that question. And then, questions like, should loans be securitized and sold into secondary markets at all? And this one, if you're not in finance, that may have sounded like a bunch of gibberish. And I'm happy to try and of course, that's part of the point, honestly, of the brand of Wall Street finance that we have today, is that a lot of the terms and a lot of the lingo and a lot of the structures are basically designed so that the smart people on Wall Street can say, let us just take care of you. We've got everything pretty well handled. But the question is, there's a report that came out yesterday by the Global Impact Investing Network called Scaling U.S. Community Investing. And one of their conclusions was that the way to increase the amount of community investing or impact investing that should be happening in the world today is that more loans should be standardized in their terms. They should then be able to be securitized, meaning sort of packaged together, and then sold onto secondary markets. And I personally, and we at RSF, fundamentally feel like that's the absolute wrong thing that we should be striving for. And if anything, we're trying to do more customized transactions with social entrepreneurs to model how that can be done, as opposed to it being standardized and quantified in the way that would be easier for Wall Street to understand. So I just wanted to introduce two people that I know well and that many of you, I think, know well, or I hope you do. Leslie Christian is a financial advisor based in Seattle, Washington. who I've had the very good fortune, and we have too here at RSF, to work with Leslie closely. We published a white paper with her in 2011 called A New Foundation for Portfolio Management that questions a lot of the assumptions of modern portfolio theory, which is kind of the blueprint that all financial advisors today use. And Leslie is really the one person out there, one of the people out there, one of the few people out there that's willing to question all the assumptions and asks the clients that she works with to suspend their beliefs. And it may be then that people want to come back to, well, I do need a certain rate of return, and I do need this XYZ amount of liquidity. But at least you go through a period of trying on what it would be like to respond to questions like the following in the affirmative. What if every cent I had to invest was invested within 100 miles of my house? And just to go through exercises like that, even in your imagination, is something that Leslie has found to be extraordinarily beneficial, and we're finding that many people are interested in engaging in at least those exercises to test the assumptions that are being that are part of the current culture of finance and investing that we have. And then John Fullerton at the Capital Institute in Rye, New York, I urge you to check out his recent white paper that's on the subject of regenerative capitalism. You can get it from the Capital Institute website. John has been at this a long time. He's a former managing director at JP Morgan, so he knows this from the inside, and he's looking at what would it be like to design a financial system based on principles of ecological systems and how the Earth systems work. We have a biomimicry approach to a new form of finance and capitalism. And so I urge you to check out those two as examples of work that's being done in this area. And then what I imagine we'll get to, naturally, there are a lot of real and perceived barriers and obstacles that each of us come up with as we encounter as we're thinking about ourselves as investors. And questions like, well, I mean, this sounds like it takes a lot of time. I've got a day job, and I'm not sure I have the time to pursue this kind of approach or this kind of strategy. Or my financial advisor tells me, don't go too fast, let's not get carried away here. You really need to examine all the incentives and structures that your financial advisor has in order to know really what kind of freedom they have to tell you what they really think, or whether they, in some cases, if not many cases, are kind of tethered to pitching you on certain things or having you go about your investing in a certain way because of how all the incentive structures tie up all the way up to the tops of these financial services organizations. You might say, I need certain returns for my retirement savings, and that's obviously a totally legit perspective to have. And so with some of the impact investing work being still forming, you may say, where's the evidence that this works? And that is a common and natural barrier or obstacle to say out loud. Then there may be things like, I'm scared. I don't really know that much about money and finance, and I'm just plain scared of what this means, or even I don't want to look stupid, to my family and friends by doing something that they don't understand, or may take a while to prove out as being a good and prudent thing to do. And so none of us want to feel stupid. So that's another completely legitimate barrier or obstacle. And I could go on, but there are many reasons why we as individuals, or even as organizations that have money to invest, haven't done more to date. But what I'd like to say, in closing, is that I'm really hopeful, and I see and we see tons of signs and signals, and hearing many voices now of people who are not just looking at this as how can I do a little bit or carve out a little bit of my portfolio or do some screened mutual funds, but really want to dig into how can I make my whole portfolio more direct and more in line with the values that I really care about and am committed to. So that's all I have time for now. But thanks for listening, and I hope that we'll get into some good questions and comments.
Thanks, Don. Looks like some questions are starting to roll in. I'll give everyone a minute or two to put some questions in for themselves. And I have a question, Don, to kick it off that came up for me. I'd love to hear a little bit more about the distinction you draw between trading and investing. I think that's really interesting. And how do you see that affecting what sort of challenges RSF is choosing to take on in relationship to the trends in the impact investing field you described?
Great. So, one simplistic way to look at it is that trading is short-term and investing is long-term. So trading is based on short-term outcomes and investing is based on long-term relationships. That's how I'm defining trading and investing. And so it's kind of scary, the frequency of news stories that come out, like one of the ones I outlined in my blog about this hedge fund called Element Capital Management in New York, that is essentially, intra-hour trading tens of billions of dollars in U.S. treasuries, and so they're betting on these minute fluctuations in the price of a security, and then skimming off, minute amounts of, the classic, they're buying low and selling high before it goes a little lower again, but it's just teeny little fractions, tens and tens of billions of times over. And they're using, in their case, they're using tens of billions of dollars in borrowed capital. So it's not even their own they're using about $6 billion of their own capital, and then they're using tens of billions of dollars that they're borrowing from other people to engage in this trading scheme. So to me, that has nothing to do with providing growth capital to legitimate businesses, which is maybe how I would define investing. That is just strictly trading behavior, and at this point, as I say in the blog, like we've seen this movie before. It's very easily could be that house of cards falls down, and then it affects a lot of the rest of us, like all of us on this call, if we're American taxpayers who ended up bailing out the banks 8 years ago. So that's a little bit more about. So I'm hoping that impact investing doesn't take on any of the characteristics of the kind of trading mentality that has essentially colonized Wall Street over the last, 25, 30 years.
Thanks, Don. It looks like we have a lot of really good questions coming in. So I'm going to try to group some of them into some common themes I'm seeing. So one theme I'm seeing a number of people bring up is questions about the benefits and risks of investing locally, both in relationship to scaling, the possibility of scaling impact investing or this sort of investing model, and also the problems with geographic differences in wealth and how investing locally is in dialogue with those issues. Great
set of questions and issues. So let's see. What I'd say first is one of the first things you can do, and this was the actual slogan from a mini movement that came out of the financial crisis in 2008, is to move your money, meaning you can move your checkings and savings accounts from a too-big-to-fail bank to a community bank and still benefit from the same level of FDIC insurance and backstop. But you'll know that the bank you move to, whether a New Resource Bank here in San Francisco or Beneficial State Bank in Oakland, these kinds of banks, you'll know that the money is going to be put out into loans in your community. And you will know also that that bank doesn't have a big trading operation on the side. It's actually generating all its profits. It's involved in taking deposits and making loans on a regional basis. And so that I highly recommend as a first step. Once you get into more direct investing in enterprises and businesses in wherever you live, there are a whole host of things that you should be cautious about. Because you shouldn't invest in an early stage enterprise with a disproportionate amount of your savings just because you like the person and they seem cool. So you really have to avail yourself of other people who are doing that kind of investing in your region. There are Bali networks and slow money networks, and there are lots of more people engaged in this kind of activity now. And so finding your peers is kind of the next thing that I would recommend, and see who might be farther along in this practice than you are, and go to school on the investments that they've made, and ask a lot of questions and start to educate yourself slowly but surely. But then actually do something. I put $5,000 into a again, I'll do my other caveat, not a financial advisor, but we are aware that there are really inspiring organizations like Organic Valley, out of Wisconsin, or Equal Exchange, in the Boston suburbs, that are, an organic milk company and a fair trade organic chocolate and coffee company, respectively. And occasionally they will open up an investing option for you to invest in. It's a fairly low risk proposition, and I think there'll be more and more companies like that that will be on the lower risk end of the spectrum, that will allow you to get a taste of what it's like to invest directly in companies. So lots more to say on that, but it's a great question. Hopelessly short, compressed period of time, but hopefully got to a little bit of it.
Yeah. Yep. Thanks, Don. I think if I could sum up a little bit what I think I hear you saying is that there are ways to invest locally, or what feels locally, I'm kind of doing air quotes here, without necessarily thinking only about geography. That's about relationship too, that can be kind of local.
Sure.
Yeah.
Yep.
We're getting a lot of questions too about retirement and how it's easy for an institution that exists to take these risks like RSF.
Yep.
But what about me and my 401k? Can I do that locally? Can I do that by walking off Wall Street? What does that look like?
Yep. Great question. And here we need to discern between accredited and non-accredited investors. So if you're not someone who has whatever it is, at least $1 million in free cash beyond the value of your house, and is making more than $250,000 or $300,000 a year, then that's a definition of an accredited investor. A non-accredited investor has fewer options, frankly. I mean, right now, I would say for accredited investors, there's no excuse not to have 100% impact portfolio. A portfolio of all your investments that lines up directly with your values, because you can invest in, directly into individual enterprises, or into venture capital funds, or other kinds of debt funds, or into a whole range of things that I won't go into. As a non-accredited investor, your options are more limited, but that is changing. There are more online, kind of crowdsourcing options that are available with the changes in the laws in 2012 that are now finally coming to fruition. There are more options that you can do there. As far as retirement plans and 401ks, I just had a conversation with Rob Thomas of Social K last week, which is a 401k provider that we use here at RSF, and I would urge you to basically hammer your 401k provider, if whoever you're using at work, to expand their level of choice and the kinds of options that they have, and the kinds of self-directed IRAs you might be able to participate in that would give you more flexibility. But most of the options that exist for non-accredited investors, through 401k plans, are still related to investing in public stocks. And so it's point well taken. that there aren't a ton of options yet, but there will be more and more. I would say I'm hoping that we do a version of this same thing in 5 years, and I think there will be substantially more options for non-accredited investors relative to accredited investors. But that's a good point. Point well taken, and I think we think about it all the time. Of course, at RSF, you can put funds here in our social investment fund with $1,000 minimum, and be very happy about the social and environmental returns you get and the low risk liquidity nature of it. So a little plug there.
Thanks, Don. We have got a lot of really good questions coming in, so I'm going to keep trying to group a bunch of them. We have a number of questions about how we might transform the financial markets as they exist, and the questions are of a tension between or among walking off Wall Street as one potential option, mainstreaming impact investing as another, and then this very important question of regulation. Mm-hmm. And one commenter pointed out that many of the activities that you are describing are probably illegal already. And so how do we think about the regulatory aspect of what needs to be done while we're also doing the other work?
Mm-hmm. Great topic. I, for one, am not a believer. Well, I'll put it this way. We are not engaged in regulatory reform of Wall Street. This would be one thing. If you want to geek out on this question, you should look at how many senior Goldman Sachs employees have been hired into senior positions in the U.S. government. The deck is stacked against us for grassroots regulatory reform of Wall Street. That's my point of view. I love that people are engaged in that work. I think it's super important, and I'm just much more of the school that we need to get millions of people to decide to invest differently at a grassroots level, and really put pressure on those firms and essentially break them up eventually, but not by regulatory edict, but rather through the fact that they can't hold on to their business model anymore the way it exists. The one area that would be again, if you watch a documentary like The Wall Street Code, you'll see how high-frequency trading works, and that it would be. I know that there are really smart people working on reforming how that is operating, and I wish them all the best, because I think that it's just plain sad at this point that there's so many people that are engaged in that trading activity where their sole goal is to make as much money as they can in the shortest possible time, with no effect on real investing. So that's the one area where I hope there will be a lot more reform.
And then in relationship to scaling impact investing, how do you see that playing into transforming the financial system? And also we had one commenter who wanted to provoke us a little bit and ask us a question about when we can, I like this, rein in the conversation about scale. What's so important about scale? And I think that speaks to your questions about appropriate growth.
Right. Again, another half dozen fascinating topics and all that. Good question, Alex. So I was on a panel at SOCAP a couple weeks ago, and I polled everyone in the audience to guess what my least favorite word was at SOCAP, and someone eventually guessed scale, and so that was it. So I think that there's this rush to scale everything that's entirely premature. I think it just feels like if everyone could focus on what's right in front of them and what each of us is directly experiencing, as opposed to thinking that we have to cook up all these new models and all these new rating systems and all these new investment platforms and securitized, standardized, approaches to loans and so forth. I feel like this is just going to evolve steadily but surely on its own, and I think we should all be careful when we encounter even the title of the Global Impact Investing Network's publication yesterday, Scaling U.S. Community Investing, like we suddenly need to press a button and have everything just get massively bigger. I think we're talking about, term impact investing didn't even exist in 2007. So, we're in the early years of a 50-year process to really shift things, and I think people need to be a lot more patient and let real stories and real outcomes evolve, as opposed to whipping into place all these new structures, which may have quite a few negative unintended consequences in my view.
Great. We have a really interesting question, I think, about RSF Prime and the way that we think about that, and whether or not we are moralizing interest. Specifically, do we talk about, with our borrowers and investors, about rates of interest that may be too high and expectations around returns? How do we manage those questions?
Yep. So for those of you, again, who aren't familiar with it, RSF Prime is what we call the way that we come to our interest rates here at RSF, as I described earlier, as opposed to using LIBOR. We have had a vigorous dialogue here for many years, going back actually to the pre-founding of RSF in the early 80s, about whether we should charge interest at all, or whether we should come up with another way that has more of a spirit of gift in it, and has a more pay it forward kind of quality to it, and that also involves kind of more cross collateralization between the borrowers in our loan fund, and also more community building amongst the investors. And I don't have time to go into a lot of that, but the headline is that we are steadily asking ourselves the question, should we be charging interest rates at all? And then beyond that, we are always trying to charge the lowest rate of interest that we possibly can. And that's why we do the community-based pricing of our loans, so that each of the participants in the financial transaction, the investors, the borrowers, and RSF, can see each other, understand each other's intentions and needs, and so forth. And it's pretty dramatic to see what happens when everyone encounters each other at those meetings. Humanizing it, bring the participants closer together, I think is going to yield a different approach to interest rates. We're just not quite there yet.
Thanks, Don. We got one question about whether we'd ever received support from the foundations associated with big banks. And more specifically, or more broadly, I mean, what do you think about corporate philanthropy or big bank philanthropy? How does that play into this question?
Great question. Another great one. So the short answer is no. We had an overture from a very large Wall Street bank several years ago to invest $100 million with us in our loan fund, and we immediately said thanks, but no thanks. All of our 1,700 investors in our loan fund are individuals or family foundations or people, organizations where we know the people whose money it is, and we feel like that's very important for us. Likewise, we had an overture from another, gigantic publicly traded insurance company that was offering to put money here in terms of supporting our reserves, our loan loss reserves underneath our loan fund, and we likewise said thanks but no thanks to that. So there again, we raise our own reserves. We don't have any FDIC insurance, but we do always have ample reserves in place for when loans, because loans we always have 100 or 150 at a time, and so there are bound to always be some that are having difficulty, and we have a 100% repayment rate to our investors, and so we maintain our own reserves. So those have been two instances where so we haven't taken any grants from corporate or big bank foundations or investment or money for things like reserves. And it's a tough one, the role of corporate foundations or say J.P. Morgan's or Citigroup's foundations. It's a tough one because I know there are a lot of really great community development organizations that get money from those foundations, and I know that there are CDFIs, community development financial institutions, that get direct funding from the big banks, and so many CDFIs do amazing work, and community development loan funds do amazing work, and so that's a tough one. As far as I'm glad that exists. We just choose to be kind of off the grid of that whole system.
Thanks. We've got a few questions about the field, so I'm going to sort of combine them. One of them is, aside from RSF, or in addition to RSF, can you name some intermediaries that are doing good deal sourcing here, where you can, that's how I would frame that question. And similarly, how are we working in the field to build out these networks of intermediaries or social enterprises or others?
I think I'll mainly take the second question because I don't want to get into too specific recommendations, and I might forget somebody and then they'll hate me forever. So we have done a ton of work here at RSF to support the conditions for a different kind of financial system, and that has involved sponsorship of phenomenal networks like Social Venture Network and Investor Circle, and the Business Alliance for Local Living Economies, and many, many others, Slow Money. And so we have tried to do everything we can to work in tandem with the good people at those organizations to move this whole thing forward and to raise consciousness and awareness about how it can be done differently. And now, with impact investing accelerating, there's a new, group like Tonic, which is a network of angel investors that's focused on, that has a 100% impact kind of wing of that network, where everyone's committing to go 100%, all in for impact in their portfolio. Where we've had the most success is in smaller gatherings of 12 to 20 people. Where we create peer learning circles, with partners like Bali for community foundation leaders, or the local economy investor circle group, or Play Big, that we've worked with Marion Moore for years, where we just feel like there's so much that individuals can learn from each other, and then we have resource experts that come in and will do a piece on, some kind of, some subsegment of the discussion. Like we had a women in agriculture gathering here of about 8 or 10 people last week that wanted to learn more about how they can get involved in investing and giving into agriculture. So it's those sustainable agriculture. So it's those smaller circles that I feel like where there's the most potency, and we're not trying to reach millions of people. We're looking to have go on a learning journey with a relatively small number of people who really want to pioneer this stuff.
Great, thanks. We have one commenter who tells a good story about someone they know who once invested in a local private prison in their community because it promised to be more humane, and it didn't work out as well on the impact side as they had hoped. So the question there is, how do you know you're sourcing the right deals, and how do you monitor those outcomes?
Great questions. So there are more and more individuals who are leaving jobs at big banks or big financial services firms who have gone through a lot of on-the-ground training, or people that are alumni of RSF for that matter, who have a tremendous amount to bring to the party. They've gone through hundreds of evaluations of these kinds of companies. And I think that my great hope is that there'll be a network of, what I call integrated capital specialists, people that understand how to underwrite and be able to tell, is this a financially viable organization, and are they really committed to social and environmental practices that are beneficial, and if so, exactly how, and how to track that over time. So there'll be these integrated capital specialists who are able to do diligence on those kinds of opportunities, like the for-profit prison you're mentioning, and then they will match up with networks of people who are investors on the ground in a particular region. And those individual integrated capital specialists will be able to work in tandem with the small, human-centered networks of people in place, so that you could avoid that in the future. I think that's coming pretty quickly now, because there's so much demand from individual investors to get some help on how to determine, is this a good or not so good investment from a financial standpoint, and then are they for real, in their social and environmental commitments? So that's a great question, but I'd say, stay tuned, or start seeking out that person now who may be a resource to you in your community. Try and steal them from the local big bank branch, or there are a lot of people who are in the profession of financial services that want to find a lot more meaning, in their work too.
Thanks. We've got a few more questions I want to try to get to before we end. A couple of questions about the complexity and diversity of revenue streams for big banks. So they are both. Can you talk a little bit more about the way that risk and complexity support these complex financial vehicles and systems? Mm-hmm. And on a related note, what do you see as the relationship between the scaling of impact investing and essentially cross-selling and fee revenue?
Mm-hmm. So let's see. The revenue models and the business models of the biggest banks rely heavily, first of all, in amassing, getting the largest pile of money in their control as they possibly can. So that's referred to their balance sheet. So an organization like JP Morgan Chase has over $2 trillion that it has in assets under management. So that's like a big goal, is just to be as big as you possibly can, because then you get to charge fees on whatever you're sitting on. Then there's the trading part. So this is the part that not many people know as much about, because the banks would just assume not have that be talked about as much. But the majority of the revenue and profits comes from what's called proprietary trading, where they're investing money, for instance, in that guy who's managing Element Capital Management, who's skimming money from U.S. Treasuries in tiny amounts, billions of times over. That's where if you're an investor in Goldman Sachs or wherever, or you have your money there, that's where your money is being, as Vince Siciliano at New Research Bank says, where's your money spending the night? That's where your money is spending the night if it's at Goldman Sachs, is in those kinds of hedge funds and what have you. And that's how they really prop themselves up. And the real banking business, like advising companies on how to raise money, or the real investment advisory work that they're doing with clients. Certainly, there's a lot of good, smart people doing that work, in big banks, and that's real work. But the problem is, it's a much smaller percentage of their overall revenue streams than people think it is. So that's on the first part of what you're saying. And then the second question was about
impact investing, and we sort of you addressed it a little bit already, the fee revenue question and cross-selling as a way of part of scaling.
Yes. So I would consider myself reasonably jaded on the motivations of the Wall Street banks in terms of they do want to serve their clients. I think, as all good businesses do, and as I say, they see this as a trend, not a fad. And so they're smart to be responding to their clients, but they are very keen to try and essentially capture more clients, with having a robust impact investing practice, so that they will participate in lots of other things that they offer. And that, not necessarily terrible thing to do, but it's relatively opaque what goes on in the conference rooms at the banks before they go out to meet with the clients about how that all goes down.
There's one last question I want to ask you last, because I think it's something I've heard you talk about in other contexts, and I'm sure it will take more than 3 minutes to answer, but we can start, which is about the relationship between all of these questions and values and spirituality. Mm-hmm. And what kind of work do we do, and how does this come up in our work in relation to these larger structural questions?
Mm-hmm. Let's see. So 2-minute version. There's someone we work with a lot as an advisor named Birju Pandya, who he did a talk recently called "Your Brain on Capitalism." So if any of you remember from the 1980s, there was a prominent print ad that was meant to get kids off of drugs called "Your Brain on Drugs," and it showed a fried egg, that was frying in a pan. So the idea here is that I think the most important thing we can do is to make small incremental changes in our approach to working with money, and try to, as often and as deeply as we possibly can, go into what kind of human being am I trying to be? How am I interpreting what's going on in the world around me? How can I best respond to that and stand up for my values in such a way that when I wake up in the morning, as Leslie Christian likes to say, you can feel like you have a beautiful portfolio. Or when you get your statement in the mail, you can start to feel like, okay, I'm starting to feel like my expression of money in the world is really matching up with who I am, and I'm really liking the effects that it's having on the people that are involved, and to the extent I can come more and more into direct contact with them, that's what I'm hoping more and more people seek out, in their investments. So to me, that's all a spiritual practice. I think that's the best and the most important thing that all of us can do.
Thanks, Don. That was a great note to end on. There were so many great questions, and this clearly sparked a lot of interest for a lot of our community. So I'm really glad we started the conversation, and I'm sure we'll continue the conversation. We are going to be sending out the recording of the webinar to everyone who was on the call. So thanks so much for everyone who joined in, asked great questions, and I hope you'll join us again for future conversations and webinars and keep the work going.
Thanks, Alex.